If we're being 100% honest, trading isn't actually that hard. The concept behind it is simple. You create a strategy that gives you an edge. You define how you enter, where you place your stop, and how you take profit. You stick to it long enough for the probabilities to play out. That's trading in its purest form. We know that the market is mostly random and unpredictable, so we create a strategy with strict rules to protect our profit and our psychology from it. The problem is, most traders go through this whole process, then ignore the rules they made in the first place and trade however they feel like anyway. It's like taking the time to build a boat to sail across the ocean and then leaving it on the shore and swimming instead. I used to have this same problem. I created an elaborate strategy with strict rules and then just didn't follow it. And by doing this, I was not only losing, but I was robbing myself of consistent profit that I could scale and compound. So I needed to fix my execution, and I needed to fix it fast, because it was all emotion and zero process. My entry came from hype, my target came from hope, and my stop loss came from fear. Nothing ever followed the plan, so nothing was profitable. It wasn't until I created a clear execution sequence, a literal checklist I couldn't argue with, that my trading stopped being stagnant and finally became consistent enough to scale and compound. So in this video, I'm going to break down that exact execution sequence so you can stay consistent no matter what the market throws at you. Before we begin, quick disclaimer. Nothing here is financial advice. I'm just showing you what's worked for me. If you use it, do it at your own risk and size properly. Now, if you think about it, our trading results are just a reflection of us. It's a very simple process. We put in certain inputs and we get certain outputs based on those inputs. If we're random and inconsistent, then our results will be random and inconsistent. If we're anxious and scattered, then our results will be scattered. If we're patient and consistent, then our results will be consistent. We can't expect to have random inputs and expect consistent results. So we need to have consistent execution, specifically consistent entries, stops, and targets to get the results we want. Everything starts from entries. Now, when it comes to entries, we want our process to be as mechanical as possible. That's why I follow the LCE method. If you're new to the channel, all we talk about is trading this level-to-level system using institutional supply and demand levels. I'll link some videos here where I go into detail on the whole system. But following the LCE method, all we want to do is enter at one supply and demand level and exit at the next level. This already solves the most important question, which is figuring out where to enter. We've narrowed it down to a specific area on the chart. Now we just need to figure out when to enter, because if we enter too early, we risk being stopped out before the real move happens. If we enter too late, we sacrifice our risk reward. So we need to know exactly when to enter for the cleanest execution and the most consistent results. The key to a good entry is first knowing where to set our alert. We don't want to be staring at the chart all day, right? So we set an alert at our level and wait for it to hit. That's when we finally open our chart and decide when to enter or not. But how do we know where in the level to set our alert? So when it comes to setting alerts, we usually want to set it somewhere near the middle and not overthink it. And we can modify it a little bit based on market structure. So let's say the cloud is strongly bullish and the cloud is following the price closely and bias aligns on all time frames. Then we could place our alert a little bit earlier, since we have more confidence that our move will play out. Now let's say instead, the cloud is further away from the price, direction isn't as clear, and we have heavier overhead market structure. Well, in this case, we would need to see more proof for the price to firmly break market structure and have a true breakout, since it's missing the momentum. This is where we'd place our alert deeper into the level and wait for more confirmation, since we have less confidence that it'll play out. But overall, we don't want to overthink our alerts or our entry. We want to be more focused on getting the general direction right. Because if you get direction wrong, then it doesn't matter how precise or accurate your entries are, you'll still get stopped out. And if you get direction right, then it doesn't matter too much about where you entered specifically, you'll still be in profit. I'll also link a video right now on exactly how to find and read direction accurately so you can watch later. But once you know how to read the direction, entries become much simpler. Then it's just about mastering exactly when to enter, but that comes with practice. As long as you're entering somewhere in the middle of a level with enough confirmation, you're doing your job. But after entry, most traders fall apart because they don't know where to place their stop loss. Because a good entry means nothing if your stop loss is emotional, inconsistent, or placed in a perfect spot that loves to get hunted. So before we even talk about targets, let's break down how to place a stop where the trade idea is invalidated, not where it soothes your emotions. So here's the thing. Based on supply and demand levels, the market can only move in two directions. It will either gravitate to the supply level above or the demand level below. That's what the next level-to-level move will be. We know this because price is attracted to institutional volume, and that's exactly where we mark our supply and demand levels. So chances are, if the price moves in one direction, it'll make it all the way to the next supply and demand level. It'll complete one level-to-level move. You can also see this for yourself if you backtest it. But what this means is that if it's moving in our direction, it'll validate our idea and hit our target. If it's moving against us, it'll invalidate our idea and move to the next level. But we don't need to place our stop all the way at the next level to find out it's invalidated. That'll just give us an ultra-wide stop with extra risk for nothing. We can find out much earlier for much less risk. When it comes to placing our stop, there are three main reference points to know if our stop is placed correctly. The first is to place it near the cloud. If we're in a breakout trade that's moving with the trend, the cloud will usually be following the price quite closely. The price will hover above the cloud or bounce on and off it in a proper trend, so placing it near the cloud or under the cloud is usually a safe and good placement, with the same level of safety as having it all the way at the next level. If the price breaks through the cloud, then it's very likely to fail to move to the next level and will probably return to the level it came from. And the second reference point is going to be market structure. So that's going to be some upper or lower wicks, or some swing highs and lows. This is just following basic trend structure and making it so that if the market breaks trend structure, it's probably not going to move to the next level. Now the third reference point is very simple, and that's just to make sure that your stop loss is placed about halfway between the two levels. If the price moves to that point, then it's much less likely to continue breaking out. And once again, you mainly know this through backtesting and live trading, where you'll see it happening over and over, and you'll have a large data set to know when a trade becomes invalid. Now that doesn't mean you'll place your stop loss perfectly every single time, but you'll have probability on your side. And most importantly, you'll have confidence in your stop and won't interfere with it. So as long as your stop is generally respecting the cloud market structure and is safely tucked between the two levels, we're confident that it's a good stop placement, according to our level-to-level system. So the entry and stop loss placement is 90% of the work. That's where most traders ruin their execution and get stuck. The last piece of the puzzle is knowing where to place your target. When we're in a breakout trade, we want to target the next supply and demand level. So that usually means placing our target somewhere near the beginning of the level. This validates our setup, while also making sure we don't overstay our welcome and get stuck in a winning trade. Now, if you do everything right with entry and stop loss placement, you should typically get a risk reward of 1.5 to 1 to a 2 to 1. It could be a little bit more or a little bit less, but this is the standard risk reward for a proper LCE trade. If it's too low, like a 1 to 1 or lower, then it means your stop loss is probably too wide, or your target is too high. If it's too high, like a 4 to 1 or above, then it usually means your stop loss is too tight. This way, you give it the proper breathing space to develop while also giving you a great return for your risk. It allows you to grow effectively and recover from drawdowns quickly. When your entry is at the level, and your stop is at structural invalidation, and your target is the next level, the entire trade becomes a straight line. There's no guessing or debating or emotional interference. You can actually follow the rules you built for yourself and execute consistently. And if you want to learn how to execute this process in the real market, that's exactly what we do inside the LCE Accelerator. We run weekly calls to keep your entries, stops, and targets clean, and you'll have a private one-on-one chat with me so you can get feedback anytime. You'll also get access to my supply and demand chart and a community of traders who all follow the same system and hold each other accountable. If you're interested, the link is below. And if this video helped you, make sure to like, subscribe, and turn on notifications. I'll see you in the next one.